Welcome to the DePIN podcast. I'm Tom Trowbridge, your host, and I'm thrilled to be here with Tushar Jain from Multicoin Capital, one of a large venture firm in the space. Has been very early in investing in DePIN. I think investing in DePIN before it was DePIN, as a matter of fact. And Tushar is a managing partner. He's been there for I think almost 7 years and has been critical in leading a bunch of investments in the DePIN project. So thrilled to have Tushar on. Welcome. Tushar, do you want to give a quick background? And for those, what I like to say, if you don't know Multicoin, you're probably listening to the wrong podcast. But give a little bit for those who don't know it. Give a little bit of background on it, if you would.
Yeah, for sure. Thanks for having me, Tom. So DePIN is actually, one of the things I'm most excited about in the whole blockchain industry. And to explain why, let me explain why we got started in blockchain in the first place and why we started Multicoin. I had heard about Bitcoin early on, 2013, bought a couple, wish I had bought more. I think everyone does back then. But Bitcoin didn't really do anything for me. Right? Like there was no functionality that it unlocked that I was excited about. So I wasn't as excited about the industry then. But what really got me excited about blockchain as an industry was in 2016, seeing the Ethereum white paper and seeing some of the first apps being built on Ethereum. And what I saw was a new method of capital formation. What I saw was the internet native version of LLCs or, joint stock corporations. And when I realized that new form of capital formation was being unlocked by this blockchain technology, I realized that this was going to be the next big paradigm shift in capital markets that exists, in the world, and that we had to be involved. So in 2017, Kyle and I decided to start Multicoin. And one of the key things that we were really excited about was new forms of capital formation. The first DePIN-ish investment that we made was Helium. So we led Helium's Series C back in 2019. And that was before they had launched the network and, before they became DePIN. They were like a traditional Web 2 type company before then. And they ended up launching the network after that Series C, and we worked with them through that process. Since then, we've invested in a number of other DePIN projects as well, and continue to be excited about this new method of capital formation in the internet native age.
One question I ask everybody is how do you define DePIN? The name is it's new. I've had people. I've been on kind of panels or podcasts where I think the definition was not understood at all. So how do you define it?
That's a good question. I actually separate what most people call DePIN into two categories: DePIN and DVIN. And DePIN stands for Decentralized Physical Infrastructure Network. DVIN stands for Decentralized Virtual Infrastructure Network. And my distinction between the two is, does the location of the hardware matter? For example, with Helium, right, like the location absolutely matters. If you have 10 million hotspots, but they're all located in the same data center, well, that's not doing anyone any good. Like, what's the point? Same thing with HiveMapper, right? Like you can have 10 million dash cams, but they're all on the same, city. Like, well, that's not actually that useful. You only have a map for one city. So that's where interaction with the physical world and location in the physical world really matters. Whereas there are other things that people call DePIN that are infrastructure networks, but the location doesn't matter as much. Some of these are portfolio companies of ours, such as Render, right? Where does it actually matter if all of the GPUs are, in a handful of places, or if they're evenly spread out over the entire world? Not really, right? Like some spread matters for latency and CDN type reasons, but it's not the core value prop Whereas for the physical infrastructure networks, it really is the core. Like the location is the most important thing.
Yeah, that is I hadn't thought of that distinction before. I certainly grasp it. And there's plenty of others. I think we get examples like that. The encompassing definition that I've been working with is crowdsourced physical infrastructure bound together by a software network that is secured and incented by crypto economics.
Oh, I absolutely agree with that. I kind of skipped that because I imagine people listening to this
everyone knows it, maybe
already.
But don't take it for granted. Trust me, don't take it for granted. You're so deep in this, you take it all for granted. But I think we had not everybody is quite that deep. But hopefully soon. Listen, and then how about you? I mean, you mentioned discovering Bitcoin. What were you doing prior to that? What's your experience before this? How did you kind of even come across Bitcoin to make this kind of really important and consequential career move?
Before Multicoin, I was an entrepreneur in the healthcare IT industry. I had studied finance, but that it was my only link to Multicoin, from a prior life, other than being, an enthusiast about technology. Generally, my philosophy is like, if you want to do something, just go do it and you'll figure out how to do it. You don't need some, free qualification or anything. Just start. So yeah, that's how we started Multicoin. It's just, we thought, let's get started and we'll learn how to do it on the way.
And how did you meet Kyle? How did you guys partner?
I met Kyle at NYU, where we both went to school. So we've known each other for 15, 16 years now, a pretty long time.
Did not realize that. Well, then thinking about then DePIN overall, take it to a high level, and then we can get specific. Scale of DePIN potential, just from a sector overall, and you can look at either DVIN or DePIN. How do you think about scale of kind of sector? And you can get into individual companies if you want. But I think, I agree. Obviously, the opportunity is enormous when you think of some of the advantages that DePIN, projects have in terms of, lack of capital, lack of capex. You could keep going, global communities, et cetera, global access to capital. But how do you think about the scale, or where is that scale most interesting to you?
I think the scale is huge. The three biggest opportunities that I see for the entire blockchain industry are, one, this non-state money. Everyone's familiar with this concept, so I won't harp on it, but this is what Bitcoin's doing. Then the next one is payments / trading. Trades are really just two payments kind of bundled together, and modernizing how payments and trading happens in the world. And then the third is DePIN. And that is this novel method of capital formation, which enables the creation of infrastructure that we previously could not have had, or at least would have had to pay, 10 or 100 times the cost to go build. And let's focus in on the third one of these, on DePIN. What is exciting about DePIN is it gives the ability to tackle some of the biggest markets in the world. If you're looking at things like the telecom market or the energy market, there are very few things that you can sell to every human being on the planet. Internet connectivity is one of those things that everyone wants. Electricity is one of those things that everyone wants. So DePIN, in my mind, is how we build the next generation of utilities. The current generation of utilities is built in this very centralized, almost like what I would call printing press native kind of way, right? Like it's built in a way that is based on that as like the underlying technology is the printing press and the joint stock corporation. And that's the way that business has been organized for hundreds of years. But now the internet changes everything, and it enables this new form of coordination. And I think we are going to rebuild a lot of that core infrastructure that our society depends on in these new, less expensive, more resilient, higher quality ways that DePIN enables. And these are, trillion-dollar markets, right? Like global energy, trillion-dollar market. Global telecom, trillion-dollar market. All right. Those are just two of the examples, but I think these are markets that are right up there with the biggest ones in the world.
And, with the examples of those, there's certain businesses where you have new hardware and are creating, a DePIN network with custom built new hardware. Sometimes, though, that hardware is relying on the actual utilities that you may be displacing, right? Like if you think about like helium in particular. And so how do you think about that? Is this actually just a more effective value capture on top of the legacy businesses in certain circumstances?
I think it's an unbundling of some of that infrastructure. For example, right now you might be getting your home internet through some cable service provider, Verizon or Comcast or whoever. And that company is actually offering a bundle of last mile connectivity with the backhaul that actually connects to the rest of the internet. And what I think decentralized infrastructure enables is it enables specialization in that stack, where you can have companies that just focus on the backhaul that go from data center to data center. And then you have these decentralized networks serving the last mile because they're able to do so much more cost effectively. And the key advantage that DePIN networks have in most of these cases is that they don't pay rent because it's owner operated, and they don't pay any salaries because it's owner operated, right? So these are huge.
And they don't have CapEx and no CapEx.
I would push back on the CapEx because the owners are putting in the CapEx, right? And they are doing that because they're economically rational actors that expect that CapEx to pay off. So the CapEx is decentralized. It's not a centralized CapEx, but the CapEx still needs to happen. Someone has to pay for the radio.
Right. The CapEx happens, but the protocol doesn't take it. So it's effectively a loan. It's not even a loan. It's a CapEx funding by others who expect, rightly or wrongly, to achieve a return on that. Right? They may be right. They may even be wrong, and their return hurdle may be far lower than what the equity markets, for example, would demand a company achieve.
That is the beauty of the whole thing, is the decentralized capital formation. What this enables is, look, if I show up with $500, can I contribute to AT&T and their their network? No, I can't. But with $500, I can meaningfully contribute to the Helium network and help expand that network. And yes, I might expect to earn some tokens in exchange for doing that. And the market will set the rate of return as to what that actually is. But yes, I am putting up that $500. The network isn't putting up the $500. And that's that decentralized capital formation that's really powerful. But then assuming just we get to the next step, the next thing is I don't need to pay myself a salary in order to keep the radio up. And I don't need to pay myself rent for that spot on my roof or my balcony to put the radio there. Whereas AT&T does need to pay people salaries and does need to pay landlords rent. So those are other sources of cost advantage on the ongoing operations, though I totally agree with you on the decentralized capital formation for the initial setup.
And so many places I want to go, but first, because we're talking and dancing around it, community. I mean, we're talking about the community effectively of the crowdsourced community funding a lot of this. The analogy I think about is the early early sellers on Amazon were critical in helping it get to scale. All they got out of that was more competition and higher prices as Amazon grew. right? So maybe they sold more books in the very beginning, but now they are, a tiny piece of a massive thing that is probably disservice them as Amazon grew. If you're early in the DePIN network and you earn tokens if the token economics are appropriate, you should profit substantially over time as that network grows. And so that leads to kind of community involvement and rewarding, and kind of curious your perspective on that.
Yeah, this is fundamentally enabled by blockchains. If Amazon wanted to give all of those early sellers on their platform some shares in Amazon, that's actually logistically really hard with the printing press level joint stock corporation type coordination that we use in these traditional companies. Or even to pick a more modern example, right? Like if Uber wanted to distribute out Uber shares to all the Uber drivers that exist in the world today, they do not have the pipes to do that. There's the mechanisms to do that don't exist. It's not that they're choosing not to. Dara, the CEO, I don't think he's choosing not to. I think he literally cannot, because there is no button he can click. There is no code he can write to actually push out Uber shares to all of the drivers. It doesn't work because we have this, legacy process of, people don't realize this, but stock certificates are like paper things that are held with the depository trust company. And you have to go through these really antiquated old processes to give people shares. And it's just slow and expensive, and it makes it not worth it to give someone shares if you're going to give them $10 worth of shares. Yes, if you're going to hire an executive and you're going to pay them $1 million in stock, it is totally worth it to go through the effort of giving them shares. But giving people $10 worth of shares, too hard. And that's where I think DePIN and blockchains enable this new level of capital formation, because they give those early community members, those core contributors who make the thing successful, without whom it would not be successful. It gives them some ability to participate financially in the upside and not just be contributors. Another example that I would give of this, and this another multi-coin portfolio company, is HiveMapper, right? People have probably heard of a predecessor to HiveMapper called Waze. Waze was a really cool crowdsourced map app, and Google bought it for $1 billion. Do you know what the contributors to Waze got? Zero.
Yeah.
They got absolutely nothing. Maybe a free t-shirt. I don't know. But they got nothing. There was $1 billion outcome and they got nothing, even though without those contributors, the map would not exist. It wouldn't be worth anything. And is part of that because Waze didn't want to give them anything? Or is it really because Waze could not mechanically give them anything? Right? Like the blockchains are a mechanical unlock on allowing community members to participate in the upside they create.
I also think, and you may know more about this than me, that there are legal hurdles to giving equity to non-employees. And so if you join a company, you can earn equity. But if you are not an employee, it is very difficult, if not impossible, to just be given shares. Like that our system isn't set up to even do that. And that's in America. Forget about, other countries where equity ownership is even less common. So I don't even think the legal structures exist to easily give non-employees equity. So sort of emphasize that point more.
Yeah, absolutely. It's all the old processes, right? Like we are moving from the industrial age to the internet age, and we have these industrial age capital markets policies that need to be adapted for the internet age. And tokens are not equity. They're like a new, different thing that, you can't paint as being equity. They're just a novel asset. And it needs to be thought of in a novel way.
Yeah, we could spend more time than we would like just on the regulatory path, without a doubt. On the token element, while we're talking about it, while we're talking about the rewarding of participants, you know, in an ideal DePIN network, whether it's Waze or HiveMapper, your example is very, worthwhile to dig into, because you'd want early participants to be rewarded. And the projects clearly would like early participants to be rewarded. For that to happen, though, the token economics also have to be correct, because you could see, and this is where also the difference between equity comes up, where equity is rather simple. It's a share of a company, it's sold for X, you get it, right? But the token economics there's a broad spectrum of how they actually operate. And I think at some point we will see divergence in terms of where some projects, the value capture is in the token, others may be successful, but it may not be in the token. And so I'm kind of curious to see any examples you have of either models you're very, you think capture value appropriately in the token, and those that may not, and kind of some of the divergence there.
Yeah, absolutely. There's two major models out there in the market today for DePIN or DePIN networks, and how their tokens work. And I call the first model the commodity asset model, and the other one, the second one, is the capital asset model. The commodity model is also referred to as burn mint equilibrium, and the capital asset model can also be referred to as the work token model, both of which are terms that Multicoin popularized in late 2017, early 2018 in one of our early blog posts. But I think the best way to call them is commodity and capital asset. So the way the commodity model works, and examples of this are Helium, HiveMapper, Render are good examples, is if you are a supplier to the network, you mint new tokens that did not previously exist. So you have a HiveMapper dashcam or a Helium hotspot, or you're submitting your GPUs on the Render network. You get to mint tokens for doing that work, or for being a supplier to the network. And then when someone wants to consume the output of that network, let's say you show up and you want to use the connectivity of the Helium network, or you want to use the map data from HiveMapper, or you want to use the GPU capacity of the Render network, you must burn tokens in order to do that. And typically, you make that a dollar-denominated amount of burn, so the cost to use a network is not volatile with token price. So you say, hey, you must burn $1 worth of Helium tokens in order to transfer 2 gigs of data over the network, or you must burn $1 worth of Render tokens in order to get this many flops of GPU compute for whatever job you're doing, whatever rendering or AI job you're doing. So that's a pretty simple model to understand. And the reason why I call it the commodity model is this is similar to how commodities operate in the real world, where if you are an oil company, you produce oil. And then if someone wants to consume that oil in order to move their car, 60 miles, they burn some of that oil. And there's an equilibrium price in the market where you look at the amount of demand and what people are willing to pay for that demand and the amount of supply, and you come to an equilibrium price for how much is a barrel of oil worth. And that's how, the Helium token or the HiveMapper token or the Render token work is. It's the same exact mechanic as oil in that case. So that's what I would call the commodity asset model. Then we have the second model, which is what I would call this capital asset model, or the work token model. And the way that this works is it's kind of like a taxi medallion. So in order to have the right to provide a service to this network, and examples of this include things like Filecoin or the Graph or LivePeer, you must stake the token, the native token of the network. And then as you do work on the network, you get paid in USDC or some other token. So, going back to kind of a real world example that people might relate with a little bit more, if you want to, in the old days before Uber, if you wanted to drive a taxi, you needed to have a taxi medallion. And what that meant was that was almost your stake that you put up. And then you were able to go do work, drive people around to their destinations and earn dollars in exchange for doing that. And so there was a yield to these taxi medallions, but you have to do work to get the yield. There are trade-offs to these two models, right? The hurdle that the capital asset model has is that it requires upfront investment, more upfront investment. Because if you're a Filecoin supplier on that network, it's not just enough that you provide the hard disks or the storage for the data. You must also go and buy or borrow Filecoin to stake. So it raises your capital costs up front in order to participate in the network. But in exchange, you also get some additional security or quality of service guarantees because there's something to slash. So if you're a Filecoin supplier and you misbehave, then actually you have put up something of value that can be slashed by the network and you can be punished for your misbehavior. And so that can increase kind of the quality of service that the customers can expect. Whereas on the commodity model, the advantage is that it just costs less because you don't have to buy anything other than the hardware in order to get started. You buy a Helium hotspot and you put it up and you don't have to buy anything else. You don't have to buy tokens and stake them or anything. But the downside is if someone unplugs their Helium hotspot or doesn't maintain it, there's nothing to slash. You cannot punish them for doing that. And so, like most things, there is a trade-off here. And one is not just superior to the other. You have to look at the facts and circumstances of the specific network in order to better understand which model makes more sense.
That's interesting, and I love that construct. And I guess the one other thing I'd put into it is what are risks of some of these models. And people talk about volatility risk of token prices going down. And you mentioned, dollar-based elements. The other risk is token prices go up so much that users and network providers don't care about actually providing useful work. And so seen that happen in a couple infrastructure projects in the boom where you make more money getting rewards than actually serving customers. And so, Fluence set up a model where it's a dollar-based, it's the infrastructure model with it, but dollar-based stake per CPU. And the rewards are also in the Fluence token, but try to track a $10 per core per month, roughly, with resets kind of daily with a max band, et cetera. But the concept there is that your reward is predictable, and that helps in a bear market, but also it's somewhat capped, which should drive interest in getting useful compute work. And that useful compute work is then still at a material 75% discount or so to what your competing cloud providers would offer. And so I think that, and you also have the slashing element that you mentioned as well. So I think that, early models, and you mentioned some of them, have done a great job. I think the other important piece here to get even more nuanced is whether the stake is a percentage of supply or is based on a per hardware or per unit element is also another kind of distinction. So even within the components you mentioned, I think there is even divergence in terms of value capture potential.
Yeah, absolutely. I love seeing experimentation on some of these new token mechanisms. Obviously, we are investors in Fluence, so disclosure to everyone listening. But we're fans of the experimentation on Fluence token design. The valuable thing here is also that everyone can learn from each other, right? Fluence is able to have this token design because, as I think Isaac Newton said, stand on the shoulders of giants.
For sure.
Building upon what came before. And also, you can adapt the model in the future, right? So if you find that there's another model that works better, these things are not set in stone. So, one thing I think people misunderstand is that they think that all of these networks are going to be like Bitcoin, where Bitcoin, the rules were established up front and the rules never change. And that is the core value prop of Bitcoin, is the immutability. It's that no one can change the rules. Even if the community gets together, there's no changing of the rules. There will never be more than 21 million Bitcoin. However, with these networks, DePINs and DVINs, that are actually trying to provide a real world service that needs to adapt to the market, needs to change. These are not static protocols. These are not Bitcoin. They are more malleable than that. And so what that means is I expect, as best practices on token design and token value capture are perfected across this whole swath of DePINs and DVINs that are experimenting, I expect that networks will start to converge on some of these best practices. So, with my investor cap on, right, like I actually try not to focus entirely on the current iteration of a project or the current iteration of how the token's value capture works. And I try to think instead more about what is the market size that it's serving, and how well is the product built for the end demand. And then I think that we will see more and more malleability on token design as best practices become established.
Well, that's actually interesting, because it goes to the next question of mine, which is, if you think about the internet, Gen 1 has been supplanted by Gen 2 or Gen 3, right? You go Yahoo, AOL, etc., right? And so if we think about DePIN platforms malleable enough to evolve where Gen 1 is the winning gen, or do you think there'll be second and third generations that can learn and innovate faster and even replace the Gen 1s?
I think that's a case-by-case basis, because you can point to the Yahoos of the world as the ones that were displaced, but then you can point to the Amazons of the world that were Gen 1 and are still absolutely dominant, right? Or there's examples in each case. I think it comes down to the execution ability of that team, specifically how future thinking are they, how malleable are they, how does a community and the users of that protocol react. So I don't think that Web 2 and Web 3 differ here, actually, where you have some Web 2 companies that have tremendous staying power and others that have been displaced by new entrants. And I think the same thing will happen in Web 3, where some of these DePIN and DVIN networks will have tremendous staying power and others will be displaced as new, more agile entrants with less tech debt show up.
Fair enough. And I mean, I guess that's a great point, where you could argue Google one from a technology perspective versus Yahoo and Amazon and eBay. There's others, one from either a combination of technology and scale that just begat scale and execution ability. So I guess there isn't one answer, I suppose. That's a relevant point. On projects, you've touched on Helium and on HiveMapper a little bit. Anything? Can you want to talk a little bit more in detail about HiveMapper or any other projects that you're in the portfolio that you're excited about and think people should know more about?
Yeah, absolutely. I imagine the listeners of this podcast are familiar with the large DePIN projects. If you're here and you haven't heard about Helium, then like you said, you might have dialed into the wrong the wrong stream. it continued to be excited about the opportunity to grow and compound into these very large markets like telecom. Like I said, there's very few things you can sell to everyone in the world, and telecom is one of them. Also, obviously very excited about HiveMapper, where they enable people to work together to build an always updated, fresh map. And people don't realize this, but when you see one of those Google cars driving around, that car costs $500,000. And they have to pay the guy who sits inside and drives around all day. And they're paying for the gas and so on and so forth. It's just so expensive. And that's why even a major city like Austin is only remapped like a couple times a year. So if a business moves in between, that's not reflected. Or if there's construction, actually just the other day, I was driving from my house to the airport and there was a new off-ramp that they had built. And Google Maps was wrong about the directions I should take. Now, thankfully, it wasn't like a huge detour, but they were wrong because they just had outdated information. So by putting a dash cam in a bunch of cars that are driving around, doing deliveries or taxi drives or et cetera, you're able to lower the cost of data collection dramatically and therefore always have a fresher map. And this is especially relevant for developing markets, right? Like if mapping is this bad in Austin, imagine how it is in Lagos or Jakarta or Mumbai or Rio, where one, they're developing faster, so there's more construction, and two, there's fewer Google cars driving around in those places, as you might imagine. So that's another one that I'm excited about. And then on the DePIN side, obviously excited about a bunch of these compute primitives, things like Fluence, obviously, I think we're both excited about. But in addition to that, a lot of these GPU marketplaces are quite compelling. For these compute marketplaces, my core thesis is that we know that demand for compute is going to grow dramatically over the next decade, whether that's from AI jobs or from virtual reality or mixed reality jobs or other metaverse related things. There are so many sources of growing demand for compute. But at the same time, Moore's law is dead, right? We can't really fit more transistors on the chip. We're running into constraints on the size of the silicon atoms themselves. That, it's a fundamental law of physics. You can't make the silicon atoms smaller. And at the same time, we have, the inability to build new fabs quickly. And a lot of the fabs that do exist are on this island that, might be invaded. And look, I'm no geopolitical expert. I don't know what's going to happen there, but I am someone who is risk-minded and thinking about the risks that exist in the semiconductor supply chain. And here we see inability to grow supply and potentially even a shrink in our supply chains for semiconductors. And at the same time, we see what I think is going to be a 10 to 100x growth in the demand for compute in the next decade. And when I see those things, I think, well, this means that the utilization of the existing semiconductors we have must increase dramatically in order to actually help meet this demand. We have a lot of idle semiconductors. My computer right now, sitting here, could be doing a lot more processing than it is today. And that's just a coordination issue. And I think if we can unlock all of that latent processing, whether it's GPUs or CPUs or other kinds of ASICs or FPGAs or anything that exist, you can potentially close that gap between the static or shrinking supply and the dramatically growing demand.
It's interesting. I hadn't thought about the demand supply imbalance. Obviously, I'm aware of the amount of underutilized supply currently, whether it's your laptop, whether it's, talk to, one of the largest networks like Dish Network. these networks need to maintain, close to 80% excess capacity to meet surge demand. So they have this massive capacity just sitting there, latent, unused, waiting for these surge events, these surge needs. And so that is exactly the type of capacity that we hope to be able to help them and others monetize. To your point, not only is that the ability to do that, but there is demand is going to be growing, even more substantially, which is a further kind of stress on the system, so to speak, which makes users of it potentially even less price sensitive down the road as well.
Yeah, we're going to see a lot of information about the elasticity of demand for compute. I think that demand is a lot less elastic than the market might expect. But this is something we're going to see the real world data of very soon.
Well, another question here. The sector is pretty new, but any disappointments you've seen? Anything hasn't gone to plan? Anything could have been better? Anything constructive or not that you can kind of point to? Any lessons learned or founders or projects you think people should draw lessons from?
Oh, that's an interesting question. There are definitely lessons to be learned. One lesson that I think we can extrapolate across all DePINs and DePINs is you need to get the token out quickly, because without the token being out, you can't grow on the supply side. And without having a substantial supply side, you can't attract demand. Like the point of the token and like the key capital formation unlock that these protocols have is that you can use the token to incentivize supply to show up before the demand is there, because the demand will never show up first. It's physically impossible to go buy a thing that does not exist. And you need to get that process going because it takes a long time and you need to compound. You can't just expect to turn it on and then everything just works. Like, it takes years. So just velocity in getting that out, I think, is important. At the same time, I think there is some management around expectations that needs to happen. Not every like early contributor to every DePIN or DePIN network is going to go make some life-changing amount of money from being an early contributor. Sometimes that happens, sometimes it doesn't happen. But I think there are some lessons around expectation management, because happiness is take expectations minus reality equals happiness, and you want to have a happy community. So if you set the expectations too high, people are bound to be disappointed.
Yeah, that is expectation management critical. And I mean, I think your point about token early is something that Kyle has always said to us without a doubt. And, I think that not only do you grow the supply side, you grow the community as well. And those are not necessarily the same things, but they feed and help each other, which is also important. On the demand side, what we've seen, and I think you've probably seen these other projects, it's far easier to grow supply side in these ecosystems than demand side. And if you also think about the entrepreneurs, most of the entrepreneurs, maybe myself accepted, are deep technologists whose strength is building technology. It's not BD. It's not the sales side of it all. And the issue with DePIN networks is once you've got the supply there humming along, you got to hit the street and get the actual users and adoption going. And I think that I just sort of foresee and see around that is some projects do that better than others. That's not necessarily core competency of a deep technologist. Have you seen any thoughts or issues or observations there?
Oh, absolutely. Also, along those same lines, like something that a lot of deep technologists sometimes suffer from is having too long of a time horizon. where it's like, they're planning ahead for, building something that's going to be future-proof for 10, 20, 30 years out. But if it's not commercially viable in the next 5 years, people are going to stop caring. And you can write the most perfect code, but if people don't care, does it matter? And will it impact anything? Right? So I think commercialization needs to be a key focus as soon as you have the tech stack, kind of built, right? Like obviously you can't go and hire a whole sales team and business development team when like your seed stage and like nothing is built yet. But that needs to be a core priority, because all of this stuff is step by step. You can't expect a big bang, where it's, I was building it, I kept building it for 10 years, and then I launched the perfect software, and then everything just worked. And like, that's just not how the world works. What you need is, I built it, I released, something that like doesn't work super well, but does, one thing, and then went and I sold it and used that to continue reinvesting in building and improving and improving and improving until I got to the final iteration that everyone's really proud of.
Yep. And listen, I think there's certain projects you've invested in that have gone through some of that evolution, which is pretty impressive and great to see. Listen, appreciate all the time here. I guess the one question to end on, well, two questions. Any sectors that you are looking for entrepreneurs in, or you think if you were an entrepreneur now and weren't in Multicoin, where you'd be attacking and targeting? You're obviously pretty excited about compute. There's a bunch of people in that space. Maybe not enough. Any sectors you would be excited about looking at or steer entrepreneurs towards?
Yeah, there's two where I would put this out as like a request for startups that I would be interested in talking to entrepreneurs about. The first one is decentralized virtual power plants. This is something that I'm quite interested in, because as the world moves to more renewable but intermittent sources of electricity, things like wind and solar, you're going to need a smarter grid in order to manage that. And on the grid, I don't think we can expect utility scale projects with, terawatt hours of battery storage or something to balance things out. I think that that's the old way of doing capital formation. And it's incredibly expensive. And I don't think anyone has the money to go do that. When you look at the current utilities around the world, or even in the US, the wealthiest country out there, like the utilities don't have enough money to invest to modernize the grid to be resilient to the intermittency of renewables. But I think with this concept of a virtual power plant, which is on the power grid, reducing demand is just as good as increasing supply. Like these are equivalent things. So when the price of electricity surges because, a cloud just passed under the sun, or the wind stopped blowing for, an hour or something like that, there's two things you can do. Either you can find an alternative source of supply, which is what they currently do with like coal peaker plants, where you fire up a coal plant in order to continue supply, or you can intelligently reduce flexible demand at that time. But the key thing that you need is the ability to coordinate that reduction in demand. If I have my Tesla plugged in at that time, me reducing that, one, like I as an individual, I'm not going to be monitoring what's going on the power grid and saying like, oh, reduce or, start charging now. But two, it's just too small, right? Like there's one car, doesn't matter. But if you can get 100,000 EV owners across a metro area to all coordinate on the same protocol, and then they can all reduce demand or increase demand as per the supply coming in from these intermittent renewables, and they can all be coordinated using a token that incentivizes them to do this. I think that's really interesting. So, and the other really powerful thing about this that I think is valuable for entrepreneurs is it's a very local market. This is not going to be a winner takes all. someone conquers the whole world and there's one virtual power plant for the world. That's not going to be the case. You're going to see local virtual power plants. I would imagine that even in a city the size of Austin, you would see multiple virtual power plants. So actually, as a venture investor, like you kind of want to see the winner take all type markets. But as an entrepreneur, I think you want to see that, even that there's room for multiple winners, because that increases your chances of having a successful outcome. So that's why I think virtual power plants are quite attractive from an entrepreneur perspective. And that's pretty interesting. So that's the first one. The second idea that I have that I would love to see more founders, this is more on the DePIN side, although I struggle to even call it infrastructure. What I want to see is a patient data DAO or a healthcare data DAO, where there is interactivity between patients and medical researchers in order to help create personalized treatments. Right now, and this was my past industry. I mentioned I was a healthcare IT entrepreneur, so I know a little bit about the space. Right now, the data sets that are available for clinical research are very limited. They're anonymized data sets. They do not offer the ability to interact with the patient. And I think that we live in this world right now where clinical research is done in this like very big bang kind of way, where it's, I have to come up with a big experiment, get all the people in, and then see if it works. And that's just so expensive. But if I could have a database of 10 million people and then figure out, by querying on that, and these people have all opted in, and I could find people who have, these two conditions at the same time, and I could send them a message and say, hey, you have these conditions. Would you be interested in trying this experiment for yourself? And it doesn't need to be a pharmaceutical. It can be hey, you have hair loss. And I have a theory that if you have hair loss and high blood pressure, hanging upside down for 5 minutes a week is going to, help with your hair loss. I'm obviously making that up. I don't know if that's just a silly example, right? But no pharmaceutical company is going to do that, because how do you make money by prescribing people, hey, go hang upside down for 5 minutes a week? But I think that there are people who are willing to do simple, safe things like that in order to help develop scientific knowledge and data about what can be efficacious. And once again, this is something that tokens can coordinate, because if I figure it out on myself and I go hang upside down for 5 minutes a week and it's like, oh man, my hair's growing back. Well, what are all the confounding variables? And like, is that valid? Like, what does that mean? But if you can get 10,000 people through this patient data DAO to all do it, then you can actually find a statistically significant outcome from that self-run experiment.
Super interesting. Yeah, I hadn't thought about that, but I think you're going back to your early entrepreneurial experience in healthcare to get that one. And it reminds me, we didn't have to talk about this, but you probably know the company ZocDoc.
Mm-hmm.
Yeah, my business school classmate was Cyrus, who founded that. So I'm an investor, and so know that business well. Which there's some elements that in a centralized way from what you're saying. But listen, thank you. Turning it back to the crypto DePIN blockchain world. Last question, 2024, where is Bitcoin going to end? What is your call?
Oh, I don't know. I'm no good at predicting prices.
Just ballpark. Are we pick some either a number or higher or lower? It's just kind of it doesn't, projects can succeed or not, no matter what that price is, but the price does help with the capital formation of the whole sector, I guess. So it's not irrelevant. But I know you're not in the business of making those predictions. That's not your job. But and maybe you can't do it. But I'm have to ask the question.
Look, I am incredibly bullish on Bitcoin over that time period. I just look at what's going on in the world, and I look at the geopolitical instability that exists right now in the world. And I look at the fact that the US government went and weaponized the dollar in the Russia-Ukraine war. And I'm not taking sides. I'm not a political person. I choose to, kind of stay out of politics. So do not take this as a political statement. It's just a factual statement that they froze Russia's foreign reserves. And like that is just a thing that happened. And other governments in the world see that that's a thing that happened. Whether it was right or wrong is for people other than me to go and decide. But the downstream implications of that are that people are going to think, especially governments, and especially governments that are not necessarily the friendliest with the United States government, are going to think, wait, how do I want to store my wealth? And we're seeing gold price rally recently as well. Actually, very interestingly, we are seeing the gold price rally while the amount of gold owned in ETFs is decreasing, which is a fascinating. That means that people are buying physical gold, which is that's not happened for a long time. And at the same time, I think Bitcoin is better than gold in every dimension, other than it's been around for thousands of years. So that makes me incredibly bullish on Bitcoin, because at this point, Bitcoin has entered the realm of being relevant for sovereigns. It's not just relevant for individuals. And I don't think the market has priced that in yet.
Yep, and you've got that while you have ETF expansion globally, which is just very, very young with years of pent-up demand. So you have ETF demand from retail moving up while you have sovereign interest as well. And that has certainly never happened.
Absolutely. And then just to add the third piece in there is what's going on with the dollar and monetary policy, right? Like you have rates are high, and we might be in a really weird situation where raising rates actually doesn't decrease inflation, but might contribute to it, because the federal debt is so high that when you raise rates, you actually increase deficit spending. And the effect of the government on inflation is based on two things: monetary policy and fiscal policy. So if by tightening monetary policy, you end up loosening fiscal policy at the same time, these two things can cancel each other out, or one can be larger than the other. The ratios of these things are things that economists debate about and no one actually knows the answer to. But we're in a really weird situation there, where raising rates may no longer be disinflationary because the debt and the deficit is so high that people are going to see soon that the emperor has no clothes, and that this fiat money system, I don't think it's sustainable. As soon as voters realize they can vote themselves all the money, that's what they choose to do. And human beings are not known for the best group decision making. So
best group long-term decision making.
Yes, absolutely. So we're seeing that play out. So look, end of 2024 is a much harder prediction for me to make, because that's short term in my mind. But if you ask me what it's going to look like in 2028, that I can say with complete conviction that we're going to be higher than we are here. And if you ask me, 2032, then my conviction is, even higher that we're going to be higher. But I'm much more long-term oriented.
Fair enough. Well, listen, I guess the answer to that question is higher. How much is unclear, but strongly convicted of being higher. Listen, Tushar, thank you for joining. How should people follow you on Twitter, on X? What's your preferred way?
Yeah, follow me on X. My handle is @Tushar Jain _ on there. Otherwise, also subscribe to our blog at multicoin.capital. We try to put out some differentiated thought pieces on there. We're not the news. We're not going to tell you things that everyone else is saying. We only try to post when we have a differentiated view, some new thought that you haven't seen elsewhere.
Excellent. Well, listen, certainly been some of those on this talk. So appreciate you coming on. Thank you very much, and look forward to having you on again and seeing how all these projects have played out. Thanks again,
Yeah.
Tushar.
Thanks, Tom. Appreciate it.